Welcome to our weekly shipping report. VLCC market under pressure amid summer lull and weak demand. Despite some mid-May signs of rate stabilization that briefly lifted sentiment, the end of May paints a negative picture for the VLCC freight market across both eastern and western routes. Spot rates for Middle East Gulf to China and West Africa to China declined by double digits, reflecting a broader bearish trend as the market transitions into the traditional summer demand lull. However, attention now turns to the recently announced OPEC Plus decision to increase production by 411,000 barrels per day in July, the third consecutive monthly hike. If these additional barrels materialize in the physical market, they could offer much-needed support for VLCC fleet utilization, which currently remains flat. As a result, a tightening of the tonnage list is not expected to materialize in early June, but the OPEC Plus output decision introduces a potentially supportive factor for vessel demand in the weeks ahead. In related developments, recent reports highlighted the more competitive pricing of Saudi Arabian light crude, which may stimulate Chinese demand in the near term. According to a Reuters survey of 4 Asian refining sources, Arab light prices are expected to drop by 40-50 cents per barrel, settling at 90 cents $1 per barrel, lower than the previous month. This would represent the lowest pricing level for Arab light since January, reflecting, and in our view, a weaker demand outlook that requires price concessions. However, in the near term, the ongoing mismatch between vessel availability and demand continues to weigh on VLCC earnings across the board. Thank you for watching. You can read the full report in our website, www.breakwaveadvisors.com. See you next week.